Welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. Today, I'm interviewing Casey Silveria. Casey is a driven agriculture advocate. Growing up on a farm, he experienced rural America's opportunities and challenges. These uncertainties led him to a successful finance career at North America's largest French fry producer. While there, Casey began his journey into farm-friendly real estate partnerships. Today, he combines these experiences to help farmers achieve their financial goals. One way he does this is by offering vetted off-farm investment opportunities. Historically, only the top 1% had access to these investments. Casey can be considered a bridge between agriculture and commercial real estate, providing an uncommon path to help farmers achieve their financial goals. Casey, welcome to our podcast.
Thank you. Thank you. It's a pleasure to be here. Excited.
Yeah, I'm happy. I'm excited to get to know your business model a little bit more and to interview you. I was recently on your podcast, so thank you for having me on your podcast. Before we
Absolutely.
keep going, I want to know more about. I'm sure the audience too wants to know more about your background and how you got into your specific niche now.
Yeah, my background is a little bit all over the place. I grew up on a farm out in Caldwell, Idaho. I the challenges and opportunities really led me to a career in finance. So I spent a decade in corporate finance, working the corporate ladder there. But there was something during that time that always was calling in me, and I couldn't really figure out what it was until 2020 hit, the pandemic hit, and I realized I really had very little financial security. There was my boss, a company who was really saying, you have to work from home now. As an extrovert and an adventurer, I hated that. I couldn't stand it. It kind of made my skin crawl. And I think a lot of other people on the podcast and listening to this can kind of feel that same thing where your skin kind of feels like crawling and you're not really sure what to do. But there's something, your value was underutilized. And so just taking a step back and looking at what you're good at and what your values are and what your background is pretty pivotal. But to short answer to your question, finance, agriculture, and now in the past 3 years, pivoting into real estate to merge those two.
Okay, perfect. So, in short, if I met you at like a Starbucks or a coffee shop, and I'm like, oh, hey, Casey, what do you? And I just met you. What do you do? What would you? What's like a very basic way of answering the question?
I would say that right now I act as the bridge between the agricultural community and commercial real estate. Right now, we see a lot of the top 1% diversifying about 25% of their financial portfolio into investments, specifically real estate
Mhm.
syndications, commercial real estate syndications. But really, a lot of these investment opportunities have been more or less private. The SEC has opened these up in the last 10 years or so.
Mhm.
So maybe a lot of people are like, this sounds like a scam. This sounds like something I've never heard of. And you're not wrong. This has only been around for 10 years. So when we go out and talk, it's really about educating people and saying you can also diversify into commercial real estate, just like all of these other investors have.
Right, and to kind of break that down, it's like if top 1%, we're referred to someone in the top 1%, they have a net worth of like $100 million. Probably about 25% of their portfolio is going to be in some sort of alternative investment, like real estate, like commercial real estate, specifically through a syndication or a fund. And the benefit of that is the potential for growth. So you can't just have the money sitting in a bank account, right? Because it's going to be exposed to inflation. But also, you don't want all your money sitting in the stock market because it could also be exposed to volatility. So there's
Yeah.
this balance, right? I think 25% probably in this case is good. I don't think there's a hard percentage, but let's just go with 25%. In this case, 25% is in commercial real estate with the potential to earn, greater than 10% annually internal rate of return on that. So that makes sense. And you're right, it is kind of a newer idea because when we think of like investing money, we probably think of investing in stocks or going to your Edward Jones agent or your local bank and opening a mutual fund. I think that's what most people think of when they think of investing their money. But there's more to it. There's a lot more to it, especially nowadays with the amount of commercial real estate available to the everyday person. to accredited and non-accredited investors. So, do you mind sharing with us some of the recent projects you've worked on?
Yeah, I fully agree with what you just said there. The recent projects that I've been a part of, there's a couple that I've been contemplating, but the one I'm invested in right now is in Houston. Put 50K into it, value add deal. It was at a time where, interest rates were on the come up. They
Mhm.
are not, 7-8% that we're seeing in today's lending environment. So we got in at a good time and really were able to secure some low financing there and a really good opportunity, good market. It was commercial real estate. When you think there's many different buckets of commercial real estate, there's self-storage, there's office investments, but then there's apartment complexes. I
Mhm.
think each asset class, if you will, within commercial real estate has its pros and its cons.
Mhm.
Um, right now, I decided to put a certain percentage of my portfolio into multifamily, specifically Houston. Great macroeconomic environment there, a lot going on. And from a workforce perspective, also just a really solid, stable workforce, especially with this asset. So with that, I'm invested as an LP right
Mhm.
now in that deal. And so as a LP, or acronym for limited partner, there's in any typical real estate deal, there's two parties. There's the GPs, or the general partners, and then there's the LPs, limited partners, who bring the capital. When you Google that on the internet,
Yeah.
probably come up with passive investors.
Yeah.
And essentially that's what I am in this deal. And that's a structure that we typically leverage for our clients as well.
Got a limited partner, limited in the sense of liability and in control, right? So like if you're a limited partner, you invest 50,000 in a deal, the most amount of money you could lose is $50,000 in this example. And then you typically don't have that much control or over where the what happens next at that point. And that could be
Mm-hmm.
and I say that more from like the standpoint of that could be a good thing, right? Like if you're a doctor, you're
Yeah.
a lawyer, an engineer, you work a full-time job, you're not gonna have time to manage real estate. There's a lot that goes into it. So that's kind of a benefit. The limited aspect is a benefit. Plus, the standpoint of liability is also a benefit because the max you could lose. From the general partner standpoint, the person signing personally on loans, technically speaking, it's unlimited risk. So
Yep.
that makes sense. And then so is your company, your fund, is it acting in the sense of like a big LP?
It depends on the structure, and it depends on, if my company, Farmers Capital Group, is providing the majority of the capital, would probably take a certain percentage of the GP, and then I
Mhm.
would, essentially do GP duties within that investment, which is no problem. But it really depends on, how big the asset is, what the capital stack is. And when I say capital stack, when you look at the balance sheet of the investment, you have your senior debt,
Uh-huh.
the debt that you got from Fannie or Freddie or a credit union, that's going to be your senior debt. That's going to have first position. And the majority of that is about 70% of the, purchase price of these assets.
Mhm.
Um, it can be from, can be as low as 10 to 20. It can be as high as, or the down payment on these can,
Yeah.
be 10% or 40%, depending on the environment. Right now, we see it more towards the higher end, 30, 40%.
Right, right, exactly. Yeah.
Mm-hmm.
Yeah, 30% now because of the increase in interest rates, right? Like it's not going to make
Yep.
sense to get a multifamily, maybe for the most part, with the lower down payment because the payments would be so high that it's going to eat into the cash on cash returns.
Yeah, that's exactly it. And when you think about a risk perspective as well, the more, like, if you buy a property cash, like, all you have to pay out is the taxes on it,
Yeah.
right? You're not out a huge debt obligation. But I was just recently actually looking a local deal. It was 6 units, and they're selling the property for about 1.3 million. But what's
Mhm.
wild right now is essentially the property was selling at a four cap, meaning, a 4% capitalization rate. What that really means in layman's terms is the return that you can expect on that property. So for every dollar that you're getting in, for every dollar of the purchase price, you're essentially getting 4 cents in net
Mhm.
operating income, is really what that means in this deal. But when you think about the debt that we're looking at in today's environment, debt rates are as high as 8%. And so that spread is causing a mass discrepancy in the marketplace right now. And for even that property to make sense, to pay off the debt and to make the bank happy,
Mhm.
um, I'd probably have to purchase that thing for about half, about 600, 560
Oh, wow.
to $600,000, which is almost half of what it is half of what they're wanting. So it's just wild. This environment that we're in, it's a wild time, and that's why for everyone investing out there and just learning, just call up people and just run the numbers yourself. Like Google how much debt is and the payment calculators,
Mhm.
and they'll throw up examples for you, and you can understand an idea about how wonky this market really is right now.
Yeah, so what happens like in this situation? What happens? I guess what's like the cure to this? Like if interest rates keep going up, then what? Do we go into all cash deals? Do we just stop buying real estate? Or kind of tell me a little bit more like what happens if interest rates just keep going up?
Well, no one has a crystal ball, and that's for sure. So it's hard to say what will happen. I mean, things are already starting to break in the system.
Mhm.
What we see from, if you take a few steps back and look at the big institutional players right now, everyone is holding a bunch of cash, and
Yeah.
they're waiting for the commercial real estate industry to reprice itself.
Okay.
And when I say that, what's happening is in 2024, there's a lot of bridge debt that's coming due. So investors got into these deals 3 years ago. They
Yeah.
said, "Hey, bank, I need a 3-year loan to cover the construction and to cover the the payment or the years of the business plan where it's most volatile and is most risky." And they said, "Okay, that's fine, but you're going to pay higher percentage, and in 3 years we want that back, and we want to refinance out of it." And right now, with interest rates as high as they are, when the investors go to refinance out of these bridge debt loans that were priced in at anywhere from 3 to 5%, within that range, they're because interest rates is an expense on the property. Expense is a driver of the net operating income of the property. Net operating income drives the value of that asset.
Mhm.
So when you decrease the NOI, the net operating income, you're directly decreasing the value of that asset. So when they go to refinance, their asset is going to be worth significantly less
Wow.
than what their what they were expecting 3 years ago when they got into the first piece of debt on the property. And so the value on these properties may not even be worth the debt that they got on them in the coming year. So when that happens, everyone with very big money is looking at this and being like, well, if we have liquid cash, then we can pick up these assets at pennies on the dollar, like 50 cents on the dollar. It's very similar to what happened.
Yeah.
I think what's going to happen is very similar to what happened in 2008 in the residential
Yeah.
markets. Everyone's familiar with that
Yeah.
financial crisis. And although the market has changed a little bit, the lending requirements for commercial banks were not as strict as they are for residential. As what they put in a lot of restrictions on what residential mortgage lenders could loan out to individuals. So, but that same thing didn't happen in commercial real estate to the same degree. Banks have their own responsibility to invest their capital where they see value, and it's just the market that we're in right now. We see some people are over leveraged, and the people that are put the right debt on their properties with the right business plan are going to come out on top. But we see the general partners in today's environment that got this debt, they're going to be squeezed, and they're because I think they didn't lock in their rates. It's going to be a big shift and a big repricing that's going to happen in 2024 is my estimate.
Mhm.
And we're kind of doing the same thing. We're raising capital right now, but it has to be a very specific deal type and very specific risk profile that
Yeah.
I'm willing to invest in today's environment.
Thanks for explaining that way. That makes, I mean, that was a very crystal clear way of explaining it. It makes a lot of sense. My question is, for example, for the properties that these bigger firms are going to buy for like half the value, like 50 cents on the dollar, what happens to those? Like, for example, let's say that I have a property now, it's supposed to be worth $1 million. That's how much my debt is, income, all that structure gets
Mm-hmm.
together, comes out to about 1 million. But I can't refinance, I can't get out of the loan. I sell it for 500,000. What happens to what happens in that situation to me in this example?
Yeah, the sad thing is that a lot of the equity that you originally had baked into your business plan when you purchased the property essentially vanishes. And it's scary that this fiat currency that we're dealing with
Yeah,
can just vanish in this way. But it's kind of like if you take snow
yeah,
and you got some really hot water right next to you. And in today's environment, it's kind of like throwing a snowball into a river and just seeing it whoosh. On the flip side of that, it's October. We're coming into the winter, obviously.
yeah,
But if that lake is already frozen, then you throw that snowball in and it's not going to dissipate as fast. Maybe it's slushy,
yeah,
maybe there's some movement, some friction, it's gonna erode over time. But right now when that happens, it's you lose your capital. And it's a scary thing. And we're seeing that right now in the markets. And it's definitely something that, yeah, it's just kind of sad to see, to be
yeah,
honest with you.
yeah,
And then it looks bad for people and it looks bad on the industry as well, which is a shame because there's great people out there and great operators, but it's kind of like one industry, blanket statement gets all of the shame when things like this happen.
yeah, yeah, definitely. So are there still like I'm sure there are still opportunities for limited partners to get into real estate now, right?
Yeah.
Despite
Oh, definitely.
everything. Yeah,
Yeah, there's deals are few and far between. I mean, let's just put it that way. Transaction volume is near historic lows, I think, in the industry
yeah,
right now.
mhm,
And so what we look for in deals is good debt. And when I say good debt, your definition of good 5 years ago is much different than a piece of debt that is good right now.
yeah,
I see debt right now that is 6, 7, 8%. So we're looking at deals that just from a net operating income make sense. Like when you think about paying off this debt, what is the debt service coverage ratio? If you have $1 of NOI, is that whole dollar going to pay the debt obligation on the investment property? Preferably what you would have in most deals is that ratio to be about $1.25 for every dollar of income for every dollar of debt. And so that equates to a 1.25 debt service coverage ratio, essentially. And so just really paying attention to those pieces and looking at the details in these deals. And that's why a lot of stuff isn't penciling out right now. It's just this debt it's crazy, crazy high in relative terms in the last 15, 20s. But we look at the 1980s, it
yeah.
was what
Like the
16% was
yeah,
the
like the
high interest
yeah,
rate back then.
yeah. So there's still there's still potential to make money as a limited partner. For those listening, wondering like should I still do this? I think if it's a good operator, a good market, a good rate, and then of course the experience of the operator is probably the most important. Then
Yep.
there is still potential. And then compared to because your money has to live somewhere. Like you have to do something with your money. Just having it sitting in the bank is probably not a smart idea. If it is going to sit in the bank, you probably want it to sit in some sort of high interest CD or saved. That's kind of like the bare minimum thing you should be doing. Not the best thing to do, but that's just like worst case for a
Yep.
very short term period of time because it's not like you could retire off of, your savings account or CD, it's probably going to be a 3 month, 6 month, 12-month window. That's all. And then you're gonna have to find another investment or another place to park that money. And I think that's what a lot of these bigger firms are probably doing now. The ones with like billions of dollars on in cash, they have it sitting in interest now because interest is not that bad. It's like 5% interest right now, but it's not a long-term strategy. Eventually, you have to do something else, or because the rates could change, they can go down, inflation can keep climbing. You have to invest the money in different places. And overall, real estate, I think, does beat other asset classes because you still own the property. You still have, in the case of a lot of multifamily, you still have people paying their rent. You still have people living somewhere paying their rent. So
Yep.
I think all those factors are worth considering. What else? And then you've kind of niched down to working with farmers, right? Like you have a business. So a farm is essentially two parts: it's the real estate and the business part, kind of wrapped together. Those farmers helping them diversify by investing into commercial real estate, right?
Yeah, that's exactly correct. So I grew up on a farm, and when I uncovered this hidden gem, I thought of commercial real estate investing and how people can participate in these deals without betting the farm. It seemed like a really big opportunity for not only myself, but looking towards the agriculture community as a whole.
Mhm.
We are largely too invested on the farm, meaning all the income that we generate is typically either put in the cash and right into the bank, right? And it just kind of sits there
Mhm.
and we hold tight, or we want to decrease our tax liability. So we go out and buy new equipment, or we invest in stocks and bonds and mutual funds. And that is typically the plan, right? And this
Mhm.
it's what is advertised
Yeah.
by advisors. They say the 60-40 split, 60% in stocks,
Yeah.
40% in your bonds. But then you uncover that the 1% are actually investing 25% into these commercial real estate syndications. And that discrepancy is something that I'm shedding light on for the
Yeah.
agricultural community and helping them diversify into these types of assets. Because, like you pointed out earlier, yeah, today's a weird market with the lending environment, but that doesn't mean that this asset class is horrible. Like, it's
Mhm.
not. Like, real estate has generated more millionaires than almost all the other industries combined. So
Yeah.
from that perspective, and from a limited partner passive investor standpoint, you can leverage the operator's experience and leverage the fact that are not investing locally. And that is huge for my clients because we live in rural America.
Yeah.
Investing in an apartment building with a population of 2,000 people, when you look at risk adjustment, like, do you have risk adjusted returns on an investment property like that? The short answer is no.
Yeah.
It's just too risky. But what we see in bigger markets like Austin,
Yeah.
Phoenix, these cities have good macroeconomic environments that farmers can leverage in their financial portfolio to really give them some financial security on making long-term decisions for their farm.
I see that. I agree. And that does make a lot of sense. Like instead of reinvesting your money back into your own operating business that you own and manage, because a lot of people do that, right? They have their operating business and they either save the cash or reinvest it back into their business. And in their minds, their business is the best security they have. It's the best asset they own. But there's concentration risk with that, meaning that all your eggs in one basket. So when you diversify, like if you're on a farm in somewhere rural, you could invest in Atlanta or you could invest in Houston or you can invest in other places where the metropolitan areas are much greater. And then in that way, the risk is mitigated, right? Like if you invest in an apartment building with
Yes.
200 units and 10% stop paying the rent or leave or whatever, you still have
Yeah.
90% recurring cash flow coming in. So there's more, you're thinking like a bank or an insurance company in this case. Like you're able, there are more predictable returns and less likelihood of losing money in that situation.
Yeah, that is exactly spot on. And just that fact alone, even the local deal that I was talking about earlier, the deal had 6 units. So pretty small, single digits, right? So even if you have one person in that property not paying rent 30% of the time in the year. And that's like one lease turnover. That
Yeah.
could be your entire cash flow for the year.
Yes.
But in these deals, these larger apartment complexes and self-storage facilities, they have hundreds of units. And so if a small percentage, just like you said, doesn't pay their bills, or maybe there's a slight dip in the market, overall, if you're in the right investment or right business plan, it's not going to matter, because that should be already underwritten in the business plan. So
Yeah.
that's why it's important to get with the right operators, get with the right people who can analyze these deals and verify those two things, that they're actually baking in these assumptions
Got it.
to really, yeah.
Yeah, it's a really good example. Yeah. Casey, it was awesome having you on the podcast and getting to know your perspective on real estate. How can the listeners connect with you and learn more about you?
Yeah, absolutely. Thanks for having me on, man. It's been a pleasure. Always love talking shop, talking real estate, and how people can, diversify into these type of assets. Best place to get a hold of me is meetwithcasey.com, or if you want to check out our website, get a hold of all of our free resources there. You can check out fcg123.com as well. So meetwithcasey.com, fcg123.com is where schedule time or check out all the stuff we have.
Okay, awesome. I'll be sure to add in those links in the show notes below, and I'm looking forward to having you back on the podcast.
Yeah, sounds good. Sorry. And yeah, look forward to next time.
Thanks. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.